So Warren Buffett once said, if you don't find a way to make money while you sleep, you will work until you die. But now going on Google or YouTube and looking up top ways to make money while you sleep, the very first thing you'll come across is by investing in the stock market. And don't worry, that's what we're going to be covering today. The ultimate guide for investing in the stock market. This is going to be beginner friendly, intermediate friendly, expert friendly. If anybody wants to make money from investing, this is the absolute best video for you. And don't worry, at the end of this video, I give you guys the best strategy for making money while you sleep. Alright guys, I hope you guys enjoy it. Let's jump into it. Roll that intro. Let's go. So now, why do people invest in the stock market? Well, people invest in the stock market for one reason and one reason alone, and that's to make money. That's to make that cheddar cheese. That's why everybody invests. People don't invest because it's fun and it's awesome or whatever. They invest to make money. And the craziest thing is people will buy and sell a stock at the exact same time. So one person's thinking the stock's going to the moon, another person is thinking this thing is over with and done. So this is one of the most important things. Before you guys invest, what I would recommend doing is do your own research before all of it. Before you guys buy certain stocks, ETFs, this is all my opinion, so make sure you guys understand that. Alright, so what is the stock market? Well, a stock market is pretty much just a marketplace where you can buy stock. You can't go to Walmart or your grocery store to buy stock. What you have to do is have a stockbroker. A stockbroker pretty much just grants you access to the exchange, and then you guys can start investing from there. Now, back in the old days, pretty much what you'd have to do is call your stockbroker and say, hey, I want to buy shares of Coca-Cola, and then they would place the order at the exchange. Nowadays, they do it all online, so it makes it a lot easier for us as consumers and investors to invest because we don't have to call anyone. And they have commission-free trading, so you don't have pretty much any wasted money. Now, a stock, on the other hand, is different than the stock market. A stock represents a small ownership inside the company. It's very, very small, but you still own part of that company. So as the company makes more money and becomes more valuable, that stock price will go up. So if you bought the stock for $10 and now it's $15, you guys made $5 profit if you sell it. But on the flip side, if you buy a stock and it starts losing money or losing value, and now you bought it for $10 and now it's $5, you lost $5 if you sell it. Now, I'm sure you guys have heard the term dividends. A dividend is pretty much when a company makes so much money, they will pay their investors. This is a great way where you guys can build up a passive income stream, because normally companies will be like a dividend king, a dividend aristocrat. And don't worry, a dividend king is when a company's been paying a dividend for more than 50 years. Dividend aristocrat is 25 years. Now, the beauty of investing into those stocks is those companies are more dependent, more reliable on paying those dividends, because there's no law that states a company has to pay a dividend. It's just a little bonus these companies like to do to help their investors out. So there is pretty much three main different stocks out there. There's something called a blue chip stock. A blue chip stock is pretty much like companies that you and I know of. They're companies that aren't as strong on the growth side, but they do very, very well over time. These companies are like Home Depot, companies like Coca-Cola, Waste Management, companies that often do well in recessions and often that do well when the economy is super strong. I would highly recommend investing into them because there is a lot lower risk, but still carries some reward. Now, growth stocks, on the other hand, are companies that are a little more risky. So companies like Google, companies like Tesla, companies like NIO, companies that probably you and I have heard of, maybe even companies you and I have used. But overall, these companies expect a ton of growth out of them. Most of the time, you will pay a little premium for them. So the company might be a little more expensive because you're investing for the future with these growth stocks. Often growth stocks don't pay a dividend because they want to use all the leftover cash to invest in the business to grow it larger. That's why companies like Google and Tesla don't pay dividends, is because they use all the cash they get to grow the business larger. And then we have something called penny stocks and speculative stocks. So these two stocks are pretty much the same. Most of the time, these are very, very risky companies, companies that go up and down at very rapid rates, companies that you'll probably see people day trade or swing trade. Overall, I wouldn't recommend the average investor to invest, or beginner investors to invest in penny stocks or speculative stocks, just because they're really risky and you guys can lose a lot of money really fast. Now, I'm sure you guys have heard the term market cap. Now, pretty much market cap is how much the company is worth. Now, how to find a market cap, or how to find a company's market cap. Now, what you have to do is take the share price and times it by the total number of shares. So here's an example. example, if let's just say a company had 10 shares and each share was $10, the market cap for the company would be $100. But multiply that out, most of the time it's like millions or billions of dollars with these companies in the market. Now, I'm sure you guys have seen companies that you and I use every single day that aren't on the stock market. Now, how a company becomes on the stock market, they have to offer something called an IPO. Now, an IPO pretty much just stands for an internal public offering. Now, in simple terms, this is pretty much just allowing the public to invest into the stock. Now, the risky thing by investing into IPOs is often these stocks will be hyped up, and then once the IPO, the stock will start selling off. But a lot of people love to invest during IPO times because if you catch the next Tesla or Apple or Google, you're buying at the lows and the stock's about to explode. Now, IPO investing is very, very risky, and I would make sure you guys understand 100% of the company before you invest. Now, if you have a very, very hard time picking and choosing different stocks, I got you. There's something called an ETF. An ETF stands for an exchange traded fund. Pretty much what it is it's almost a pool of different stocks or commodities or bonds. Pretty much the beauty of investing in the ETFs is it's a lot lower risk. You're diversified, you can get some dividend growth, you can still get appreciation. It's just a lot lower risk and it still carries a lot of potential. Not to mention you guys can invest in the indexes like the S&P 500 or the Dow Jones or the NASDAQ, and it's a lot more affordable than investing into these otherwise. And this is why, if you wanted to invest in the S&P 500, instead of going out and buying the top 500 companies, you can just invest into this ETF that is a lot more affordable and still carries the same growth. There is a small fee often with ETFs, but it's a lot more affordable than 401ks, mutual funds. Honestly, most of the time it's like 0.04%. $4 for every 10,000 you have invested, which is virtually nothing. And not to mention, ETFs often will have different sector breakdowns. So pretty much what that means is if you just want to invest into a technology ETF, there's technology ETFs. If you wanted to invest into real estate ETFs, there's real estate ETFs. If you wanted to invest into any sector ETF, all you got to do is look it up and there's most likely one already out there. All right, so now that we understand pretty much all the top investments, the next thing is account types. Now, before you guys pick and choose the broker you want to make sure the broker you choose has the account type you want. Now, there's several different account types out there, and the beauty of these different accounts is there's different incentives that each account type may have. So there's something called a standard broker's account. This is going to be the most common account out there. This is pretty much like all the popular ones you see on like Robinhood and all those. Now, the issue with a standard broker's account is there's no tax incentives with it. Now, comparing it to like an IRA account is specifically designed for retirement. Now, there's several different IRA accounts out there. There's like a spec IRA, which is for people that do self-employed work. There's a Roth IRA where you won't pay taxes when you retire. You'll pay them before, and you're expecting to make money down the road. Now, there's something called a traditional IRA, which is pretty much you're gonna pay your taxes when you retire, and you'll get a little discount on it. Now, I think it's always smart to do heavy research with the account type you want because there's also different money limits you guys can put in. If you want to put in $100,000, you're not going to be able to do that with an IRA account. The max you can do is $6,000, so maybe a standard broker's account is better suited. Now, what I would recommend doing is if you're looking to make money day trading or swing trading or trading in general, I would recommend a standard broker's account. If you're looking more towards retirement, then pick one of the IRAs that meets your needs. Now, speaking of day trading, what is it? What is day trading? Day trading is when you buy and sell a stock during the same trading day. The ideal goal is to make a ton of short profits throughout the day that add up over the next month or 2 months or year where you have some profit. Now, I'm sure you guys will see YouTube videos of people making $100,000. I wouldn't recommend day trading, especially for beginners. It's very risky. Like 98% of people that try swing trading are unsuccessful. It's hard to do because you have to be 100% fully committed to do it. It's expensive and it can cost you guys a lot of money. Now, swing trading, on the other hand, is a little different. You buy a stock, you hold it for more than a day but less than a year. If you buy and sell a stock during the same trading day, that's considered a day trade. Good job. But if you hold it for more than a year, that's a long-term investment. It's a different tax bracket strategy and I wouldn't recommend it. On average, I hold my swing trades for about 2 weeks. The ideal goal of both swing trading and day trading is to take short profits that add up over the course of a month or 2 months or a year. Now with swing trading and day trading, you're going to be using something called technical analysis. Technical analysis is just looking at the chart to get a general direction of where the stock could go. It's not looking at like the revenue and fundamentals of a company. Fundamentals, on the other hand, is looking at like the cash flow, the balance sheet, looking at the revenue, the earnings per share, all the little stuff that a lot of people really don't care about. Only long-term investors. Now the last and final thing that all beginners should know is with REITs. REITs is pretty much just a real estate ETF. These companies go out and buy different real estate properties, and as the tenants pay their lease and rent, you guys get a little bit of that money in the form of dividends. There's a whole bunch of ones that I highly recommend, like Maine, like ticker symbol O, like VNQ, all these real estate ETFs or REITs that do very, very well. Now the beauty of REITs is by law, they have to pay 90% of the profits back to their investors as dividends, so you can get some passive income with investing. So we hit the time of talking about the best strategy for everybody. The best strategy for every investor is very, very simple. Everybody loves to just overcomplicate it, but what it is you're gonna open up a Roth IRA. And the Roth IRAs, you're gonna be paying the taxes now, not when you retire, because you wanna have a ton of money and you don't have to worry about taxes. So you're gonna want to invest in the ticker symbol VOO. This is Vanguard's S&P 500 ETF. So it's the top 500 companies all pooled together. The beauty of this is since the inception, or since it started, it's had an average return of 13%, which is really good. Now, investing into these companies, it's all companies that you and I know of. So companies like Apple, Home Depot, Microsoft, companies like that. Now, if you guys invest $50 per month into this, which is not that much, you guys will retire in 45 years with about $1.1 million. And that's a retirement income of about $30,000 per year in just dividends. So this is the best strategy because it requires a little maintenance of doing and opening up a Roth IRA. And I'll put links down below to all the brokers I recommend, but it's opening up that Roth IRA and then just investing into VOO, and that's it. Everybody loves to overcomplicate it with different techniques and strategies. I found that the best strategy is always the most simple. So that is a beginner's guide to investing in the stock market. We'll do a part 2 later this week, so I hope you guys enjoyed it. We'll see you guys later. Take care.